Are you thinking about applying for a mortgage? Without a doubt, this is one of the most important financial decisions of your life. After all, who wouldn't want to own their own home? However, before taking that big step, you should be aware that there are things that no one tells you. Did you know that a mortgage can be the best investment or a financial trap that you can't escape for decades? It all depends on what you know before you sign. What if interest rates go up? What if the value of your house falls? Do you know what you're actually signing? But that's not all, because the real story begins after you sign the papers. Are you prepared for the hidden costs, variable rates, and decisions that can make the difference between paying off your home in 20 years or being stuck with an endless payment? We're going to break it all down in this video, from how to choose the best loan to how to handle it after you have the keys in hand. Would you like to know the secrets that banks don't want you to know about mortgages? Then watch this video until the end, because what you are about to learn could save you a fortune and, above all, give you peace of mind that you are making the right decision. Important concepts. Buying a home is a big step, but before you get excited about holding the keys, there's one key decision: how you're going to finance it. Few people have the money to pay cash for a home, so most opt for a mortgage. A mortgage is basically a giant loan that helps you buy a house with the property as collateral. In other words, the bank lends you the money so you can buy the house, but if you don't pay back, that same bank has the right to take the house away from you to get back what they loaned you. Therefore, it is important to understand how it works before signing one of these contracts. Let's analyze, then, some key concepts to understand a little better how all this works. First, there's the principal, which is simply the amount of money they're lending you to buy the house. This is the amount you have to pay back in full. But of course, the bank isn't lending you that money for free. They have to make some money too. This is where interest comes in, which is what they charge you for lending you the money. That interest rate is expressed as a percentage and is what determines how much you'll end up paying in total. Then there's the term, which is how long you have to pay back the loan. The most common terms are 15, 20, or 30 years. The longer the term, the lower the monthly payments will be, but you'll end up paying more interest. Conversely, with a shorter term, the payments will be higher, but you'll pay less in interest over the long term. So you have to crunch the numbers and see which option best fits your situation. Finally, there's the issue of amortization, which is how you'll pay off your loan. Each time you pay your monthly installment, part of it goes toward principal, or reducing what you owe, and part of it goes toward interest. At first, most of your payment goes toward interest, but over time, more of your money goes toward principal. This process continues until you finally pay off your home. Now let's look at the different types of mortgages. Before you jump into applying for a mortgage, it's important to know the different types of mortgages available, because not all of them work the same way. Depending on your situation, one may suit you better than another. Let's look at the 4 most common types of mortgages: fixed rate mortgage, variable rate mortgage, hybrid mortgage, and reverse mortgage. Let's start with the fixed rate mortgage, which is one of the most popular, and for good reason. With this type of mortgage, the interest rate remains constant throughout the term of the loan, meaning your monthly payments will always be the same, no matter what happens with interest rates in the market. This stability is ideal for those who prefer to plan their finances for the long term, without having to worry about unexpected fluctuations in their payments. By knowing exactly how much you'll pay each month, you can budget more accurately and avoid unpleasant surprises. Although at times it may seem like you're paying a little more than with other options, the peace of mind that comes from having fixed payments for 20 or 30 years is invaluable to many people. The variable rate mortgage. A fixed rate mortgage works differently than a fixed rate mortgage in that the interest rate doesn't stay constant. This type of mortgage is based on a benchmark index, such as LIBOR or the Consumer Price Index, which means your interest rate can change over time. This means that if the index goes up, your monthly payments will too. However, if the index goes down, your payments may decrease. This variability can be attractive if you plan to sell the home before significant interest rate adjustments occur. However, there is a risk if you decide to stay in the home for the long term, as you could face unexpected payments if interest rates rise too much. Another interesting type is the hybrid mortgage, which combines features of both fixed rate and variable rate mortgages. This type of mortgage starts with an initial fixed rate period, typically lasting between 3 and 10 years, where you'll enjoy the stability of predictable monthly payments, making financial planning easier. Once the fixed rate period ends, the mortgage converts to a variable rate mortgage, meaning the interest rate will begin to adjust based on a specific index, just as we discussed earlier. The hybrid mortgage can be a good option if you expect your income to increase in the future. Finally, there is the reverse mortgage, which is a more common option for older people who already own their home and are looking for a way to earn additional income without having to sell their home. Unlike traditional mortgages, where you make payments to the bank, with a reverse mortgage, the bank pays you, using your home as collateral. It is an attractive option for those who need liquidity in their retirement, but do not want to move elsewhere. Before continuing, if you find this content useful, I invite you to leave a like and subscribe to the channel so you don't miss the next video. Now let's get on with it. But what should you consider before applying for a mortgage? Once we have understood the key concepts of mortgages and the different types that exist, it is time to analyze what aspects we should consider before rushing to apply for one at the bank. Evaluate your financial situation. The first step is to make sure you are in a good financial position to take on a loan. Ask yourself how much you can afford to pay each month without sacrificing other areas of your life. It is crucial to be clear about what amount will not break the bank and allow you to maintain your lifestyle. Ideally, the mortgage should not exceed 30% of your monthly income. You also need to consider whether you have enough savings for the down payment and closing costs. Often, these costs can be higher than expected, so it is best to be prepared that don't be tempted to borrow more money than you can actually afford. Banks may offer you a higher amount than you're comfortable paying, but that doesn't mean it's a good idea to accept it. Simply put, you need to be realistic about your budget. Your credit score is important. Your credit score is one of the most important factors lenders consider when evaluating your application. This number reflects your payment history, how you use your credit, and the amount of debt you have. In short, the higher your score, the better the terms you'll be offered. So if you're thinking about applying for a mortgage, it's critical to take a look at your score. If you find that your score is low, it may be a good idea to wait a few months to improve it before jumping into applying for a mortgage. Take that time to pay down your debts, reduce your credit card usage, and make sure you don't have any late payments. Not only will this help you get better interest rates, but it will also give you more confidence when negotiating with the lender. Don't forget that there is an initial payment. The down payment is simply a percentage of the total value of the house that you have to pay up front. Typically, banks ask for 20% or 30% down payment. This is important because if you pay that amount, you avoid having to take out private mortgage insurance, which is an extra expense that adds to your monthly payments. Now, if you can't come up with all the money for that down payment, all is not lost. There are some mortgages that allow for a lower down payment, but keep in mind that this can make the loan amount more expensive. Compare different options. Never accept the first offer you get. Comparing mortgages between different banks and lenders can save you thousands of dollars in the long run. So don't settle for the first option you find. When you start shopping around, there are several things to keep in mind. First, interest rates are key. A small difference can have a big impact on what you end up paying. Also check out closing fees, as these additional costs, such as appraisal fees and government taxes, can vary quite a bit from lender to lender. Don't forget to ask about prepayment penalties too. Some mortgages penalize you if you decide to pay early, which could be a problem if you want to pay off your debt sooner in the future. And finally, look at what other customers have said about the service they've received. The experience of others can give you a good idea of what to expect when dealing with a lender. So take your time and pay attention to these points. You'll thank yourself later. And then, what happens after applying for a mortgage? Once the closing is complete, you will receive the keys to your new home and you can move in. However, don't forget that this is just the beginning of your journey as a homeowner. That's why, below we will give you some important tips to manage your mortgage wisely and thus avoid surprises in the future. Make additional payments when possible. One of the secrets to saving a lot of money on a mortgage is to make extra payments when you can, even if you can only pay a little more each month. That can make a big difference in the amount of interest you end up paying over the life of the loan. Imagine you have a 30-year, $200,000 mortgage. If you decide to make an extra $50 payment each month, you could shave several years off your term and save thousands in interest. Beware of late payments. Failing to make payments on time can get you into serious trouble. Not only will it hurt your credit score, which as we saw earlier is super important, but you could also end up paying extra fees, which is not nice at all. To avoid all that stress, it's best to set up automatic payments. This way, You make sure you never miss a deadline, and you can sleep easy knowing your payments are being made on time. Consider refinancing your mortgage. If interest rates drop significantly after you've secured your mortgage, or if your financial situation improves, you may want to consider refinancing. This basically means taking out a new mortgage to pay off your old one with a lower interest rate or more favorable terms. This could save you a lot of money in the long run. But be careful before you jump into refinancing. Make sure you do the math. You need to see if the savings you'll achieve on your payments are worth it compared to the costs that come with the refinancing process. Have an emergency fund. Mortgages are long-term commitments, and as we all know, life can be unpredictable at times. Having an emergency fund that covers at least 6 months of your mortgage expenses is important. This can help you if you lose your job, face an illness, or any other unexpected event arises. This ensures that you don't fall behind on your mortgage payments, which helps you maintain your credit score and avoid bigger problems. As the old saying goes, better safe than sorry. Remember that a mortgage is a tool, and how you use it will determine whether it becomes an opportunity to improve your financial life or a burden. Have you ever applied for a mortgage? How was your experience? Leave us your answer in the comments. Well, that's all for today. If you enjoyed this video, don't forget to give it a like and subscribe to the channel so you don't miss the next content. See you next time.